Okay, so having finished up the balance sheet, let's turn to the income statement. We'll dissect it, looking at some parts that have so far not been covered, and then we'll spend some time on the back end talking about the tools that we can use to analyze financial statements. That discussion will be necessarily superficial, given the nature of this class. If that's the sort of thing that interests you, I encourage you to take a full semester course in financial statement analysis. Having said that, we've actually got a pretty good basis already in understanding where the income statement can be fiddled with. As we've been going through the balance sheet, we've identified places where our choices or estimates can have a significant impact on reported net income. And in your work on Ronco, chances are you made an error somewhere on the balance sheet, and it showed up as an error in the income statement as well. And why is that? Because the balance sheet is where we park the differences between cash flow and net income. We recognize sales, but we don't get paid in cash. That's an account receivable. We buy stuff for resale, but we don't expense it until it's sold. That's inventory, and so on. Let's go back and review some of these things. For each of these items, stop the recording and spend a few minutes thinking about what we did for that topic and how that might affect net income. Then, restart the recording. We start way back in Chapter 4 with our accounts receivable. Think back about the choices we made with our receivables. How does that impact net income? Well, first and foremost, where do the receivables come from? When we make a sale, right? And what governs when we get to recognize the sale? Our revenue recognition rules. Have we done the work? We'll debit accounts receivable and we'll credit sales. We can certainly be more or less aggressive in our determination of whether or not we've done our work, particularly when we're looking at long-term complex projects. So there's a little bit of discretion. And then on the back end, every year what do we do with our receivables? We assess how much we're going to collect and we recognize bad debt expense. And the discretion we have in this journal entry here shows up in the income statement. Inventory. What do we do with inventory? Well, there's that whole LIFO-FIFO thing, right? We saw that our choice of method had a huge impact on our financial statements, both on the balance sheet and on the income statement. Further, that choice affected after-tax cash flow, making this an even bigger deal. That wasn't just bean counting. What else is there? Well, we used our inventory section to purposefully manipulate the reported results over 2 periods. Remember that? It was our lower of cost or market rule that let us shift income from this year to the next. Property, plant, and equipment, our PP&E. What was the biggie there? Our depreciation, right? And what choices did we get to make associated with depreciation? Method, straight line versus accelerated. Useful life, or how long we think we're going to get the revenue out of this asset. Salvage value? How much do we think we can sell this thing for when we're done with it? And there's a number we just picked out of thin air. And of course there's the initial question about how much to capitalize versus expense. Training, dry runs, installation, even interest. Those are all things that we can choose. And if we decide we want to expense some of that stuff this period, there's not an auditor in the world who's going to stop us and tell us that we have to report higher net income. They like it when we're conservative, because that means they're less likely to get sued. And then we could go into the realm of out-and-out fraud when we're talking about betterments, the same way that WorldCom did with their fiber optic network. And of course our other accrual choices. We've got our warranties, which are an estimate, as well as our other contingencies. We have our pension plan, if we're one of those firms. And you don't even want to know how those numbers get calculated. I sometimes have nightmares about them. But those are based on estimates and actuarial statements and relate to money we're going to spend in 20 years. How reliable is that stuff? And again, there's the out-and-out fraud if we decide to expense something that isn't going to be paid out until next year, like wages, utilities, or any other expense. So we've got all these estimates that we're making, and all these choices, and by and large, they all flow into income from operations. And we need to understand that there is this flexibility. As I said back at the beginning of the semester, my biggest goal for this class is to make you aware of when you're out of your element and when to go call for help. Financial accounting is a complex topic, and it's easy to use information incorrectly. And the stuff that I've shown you isn't even the Enron stuff. That was some crazy complex stuff that I have to stop and think about to get my head around. You don't want to be the next Ken Lay saying, "I'm a strategy guy, not an accountant. I didn't know a thing." Because that sucks. So beneath income from operations are a number of other important pieces of information we can use to make decisions. The first is interest revenue and interest expense. Again, thinking back to our chapter on debt, interest expense is based on how much we borrowed and what the interest rate was, not the cash that changed hands. That is, it's accrual based. And we have this pulled aside from operating income because interest expense is a function of financing decisions, not operational decisions. If I want to compare the management of two firms and assess how well they're running their business on an operational level, interest expense doesn't belong in that comparison. It is an expense, and it belongs in net income, but it's not operational. Also in this section, we'll have interest revenue, but unless we're a bank or insurance company or some other entity whose business it is to make loans and invest in debt, we shouldn't have a whole lot of this. What are we paying managers for in the first place? Not investing in bonds, because we can do that ourselves. We pay them to run the business and earn more than the interest rate on debt. From an accounting standpoint, we calculate interest revenue the same way we did our interest expense. If the loan carries a premium or a discount, we'll amortize it just like we did our bonds. As a practical matter, in most cases, we can just squish interest revenue and interest expense together and report a single net number. What else do we find down here? Income from investments. Way back in Chapter 2, we talked about why Coke wanted to invest in other companies. In some cases, we're looking to make a buck as part of our cash management system. In some cases, we're looking to exert some influence over the operations of a key supplier or distributor. In some cases, we're looking to control a company soup to nuts. The way that we account for investments will differ based upon which of those three categories the investment fits best. The first method is called the cost method, and this is for those that fall into that first category. We own some shares and we're hoping to make some money off them, either through dividends or capital appreciation. But we don't own enough that when we pick up the phone, their CEO listens to what we have to say. We've got no ability to influence their operations. As we receive dividends, we'll call that investment income, and at the end of each period, we will mark the investment to fair market value, since the value of a stock we hold meets both the relevance and reliability criteria. As a general guideline, if we own less than, say, 20% of the outstanding shares of a company, this is how we're going to account for it. The second option is the equity method. We use this method when we do have the ability to exert influence on the operations of the investment. In this case, we're not going to call dividends revenue. Rather, we will recognize as an adjusting entry our proportionate share of the investment's net income on our own books. Why don't we call dividends revenue? Because if we have the ability to exert influence, we could call them up and tell them to declare a dividend when we needed a little extra padding on our net income. That would clearly be less than ideal, so no dividend revenue for these guys. When we do get a dividend, we will treat it as a return of capital rather than as revenue, and we are basically doing an asset swap. We own a little bit less investment, and we own a little bit more cash. We typically use the equity method when we own more than 20%, but less than 50% of the outstanding stock of a company. It's important to remember, though, that this 20% guideline right here is just a proxy for the ability to exert influence. We could own 49% of a company and be able to exert no influence. When? If one other guy owns 51% and goes, la la la, I can't hear you, anytime we try to talk to him. We could own 15% of a company and have a huge influence. When no one else owns more than, say, 1%. People will look to us for leadership, and our opinion is going to matter a lot. Our third option is consolidation. We use this method when we have the ability to exert control, which typically means 50% of the shares plus 1. If you remember back in Chapter 2, when we were looking at the financials, when we consolidate, we report 100% of the assets and liabilities on our subsidiary balance sheet, and we report 100% of the revenues and expenses on our income statement. To the extent that we own less than 100% of the company, the non-controlling interest stake in the firm will get a line at the bottom of the equity section. The last page in this notes packet is an excerpt from Citi's balance sheet that shows you where that goes. Again, this 50% is a guideline. There are some cases in which we might own more than that and yet not consolidate. This would be in cases of bankruptcy, when the court controls the subsidiary, not the parent. Or in cases of foreign subsidiaries in countries that restrict the parent's ability to touch those assets. Also, it's actually possible for us to own 0% of the shares, and yet we would still be considered in control of the firm and would be required to consolidate. On the next page of your notes, you will see an illustration of how contracts used to be structured to avoid consolidation. Let's say that Dave Corp wants to get into this venture down here, and it's going to require a lot of debt, but Dave Corp doesn't want that debt showing up on its books through consolidation. What it does is it hires someone to act as a shell corporation, and it's this corporation or individual that has the controlling or complete equity interest in the venture. The shell has no real assets, so when it goes to the bank to borrow money, Dave Corp here has to provide this loan guarantee in order for the bank to provide the money. The bank is perfectly happy with this, so loans the money and the venture is underway. Of course, shell is really just a shell and has no ability to actually run the venture, so signs a management contract with Dave Corp to run the business. What does Dave Corp get paid for all of the work? Well, all of the profits here minus a return that goes to the shell for their investment. So what's really going on here? If the business does well, Dave Corp is rich because they got all of these profits. If the business does poorly, Dave Corp has to pay back all of these loans, and that wouldn't be so good. Who is the one in charge of the venture? Dave Corp. And yet, since Dave Corp owns no shares, this relationship is completely excluded from the balance sheet. Pretty cool, huh? This is what is called a variable interest entity. Dave Corp's interest in the venture varies based upon the venture's performance. After Enron, the rules changed to make the strategy no longer work to hide the debt, so if someone wanted to do this, they would still be forced to consolidate. Briefly, let's look at how we account for the cost and equity methods. Assume that we buy 20% of Daveco for $200,000 at the beginning of the year. During the year, Daveco earns $300,000 in net income and pays $50,000 in dividends. Also, assume that the value of our investment changed by $20,000 during the year. For the cost method, when we make the initial investment, we credit cash for what we paid, and we debit the investment in Daveco stock. No matter what method we use, this entry right here is always going to be the same. When the dividends come in, we debit our cash, and we'll credit our dividend revenue. That's our 20% share of the $50,000 in dividends. At the end of the period, we'll plug the investment account to get fair market value and recognize the gain or the loss, either through other comprehensive income or directly through the income statement. This can go to other comprehensive income or net income, depending on the classification. Under the equity method, we once again record the purchase, but when we receive the dividend and debit cash, we'll treat this as if they're giving us some of our money back, crediting the investment account for $10,000 instead of dividend revenue. There's no way for us to finagle extra profits out of them. This journal entry is simply assets go up and assets go down. The investment income will come as an adjustment at the end of the year, when we recognize our proportionate amount of the investee's net income with a credit to revenue and a debit to investment. In this case, we deserve 20% of their $300,000 net income, so we'll recognize investment revenue of $60,000. What happens if our investment loses money? The journal entry is reversed. We would debit investment loss, and we would credit investment. We call it the equity method because our interest will increase and decrease in tandem with the investee's equity. New rules allow us to report equity method investments at fair market value as well, but I would expect that this is going to be a rare thing in practice. If we do, the journal entries would be the same as under the cost method. So after investment income, we come down to a new subtotal, income before income taxes, and then we have to calculate our tax expense. Now, income taxes are a pain in the ass. I don't say that because I'm a libertarian. I say that because I'm an accountant. Taxes present a challenge to us because the tax code is not written with the same goals in mind as accrual net income. The accountant's net income is supposed to capture the change in value created by the firm during the period without regard to cash flow. The tax code, however, is designed first and foremost to generate revenues, and secondly to promote social or economic goals like home ownership and business investment. A result of the first goal is that it's cash-based instead of accrual-based, and the second goal means that there's all sorts of inconsistencies in tax policy. So here's the problem. We're going to recognize our tax expense for income statement the exact same way we recognize all of our expenses, on the accrual basis. And the accrual basis says what? I believe in my heart of hearts that I've incurred an expense, and I may pay it now, or I may pay it next year, or I could have paid it last year, but none of that matters. I know that I incurred an expense now as a cost of generating revenue now. Whereas the IRS, using this thing called the modified cash basis, doesn't care about receivables, or payables, or prepaids, or accruals. What they care about is when did the cash go out, or when did the cash come in. There's no such thing as an allowance for doubtful accounts for tax purposes. So this creates a problem. What we believe in our heart of hearts should be our tax expense is not going to jive with what the IRS asks us to pay in any given year, because our income tax expense is going to be based upon our accrual net income. I know I pay a 40% tax rate. If I had pre-tax income of $1 million, I'm on the hook for $400,000 regardless of what the IRS asks me to pay this year based upon tax calculations. The IRS might say, you received $1.2 million in cash, you wrote checks for $5 million. That means your taxable income is only $700. Send us a check for 40% of that. An easy way to see this would be with receivables. Let's say that this is our first year of operations, and we end with $100,000 in accounts receivable. Now, for accounting purposes, we know that when we debit accounts receivable, we're going to credit revenue, and that revenue shows up on the income statement as net income. But the IRS said, no, that's not taxable revenue since you haven't gotten paid yet. What does this mean to us? Well, if we had pre-tax net income of, say, $20 million, we should recognize income tax as 40% of this, or $8 million. But our taxable net income reflects only the cash receipts, and so now we are only being taxed on $19,900,000. What do we write the check for? $7.96 million. So what this means is that we're going to debit our income tax expense for the $8 million. We're going to credit taxes payable for $7,960,000, and what is this $40,000 difference? It's a liability. It's money that we think we owe the government, but they're not making us pay yet. Make no mistake, we will have to pay that in the future when we collect the cash from our customers. We know that we're going to have to write a check, so credit the liability, and we'll call it deferred tax liability. It's a deferred tax liability, not taxes payable, because it isn't payable yet. It'll only become payable when that cash comes in from our customers. Now, let's fast forward to next year. Let's say things are better now, and we've got pre-tax net income, in this case, of $25 million. And for the sake of mathematical simplicity, we end the year with 0 accounts receivable. Now, the IRS is saying that in addition to the money that we think we earned, they're going to tax us on that extra $100,000 of cash that came in. Here's the reversal. So for tax purposes, our taxable income is $25,100,000, not the $25 million that we report on our income statement. And this means we're going to have to write a check this year for $10,040,000. But in our heart of hearts, we know that we really only earned $25 million, so our tax expense should only be $10 million even. What's happening? We're finally paying that $40,000 we knew we owed way back then. There's the reversal, and there's our payable. One of the biggies is depreciation. If you remember that class, we saw 3 different ways to calculate our depreciation expense. 2 of those were straight line and double declining balance. Most firms use straight line for their book purposes, and the tax code requires us to use some variation of the double declining balance for many of our assets. So the depreciation expense we report for book purposes and the depreciation tax deduction we get are going to be different virtually every year. That will in turn push pre-tax net income and taxable income apart. But we also know that over the life of any asset, the depreciation expense is going to be the same regardless of what method we use. And so this difference will end up reversing itself in the long run. We'll get an extra deduction now, but much less deduction in the future. Go back to the Chapter 6 notes and take a look at how we depreciated that machine and how the timing, not the amount of the depreciation, was the only difference. Fixed assets will generate that exact same sort of deferred tax liability. Your textbook goes in the other direction. It creates a deferred tax asset instead of a liability. In that case, we're being taxed on income that we don't think we earned, but the IRS thinks we did. It's the same process, just in the other direction. Regardless of the direction, On the income statements, you will often see tax expense broken into a current portion and a deferred portion. The current portion is what we have to write the check for in the current year, and the deferred portion is that plug number that gets us to the expense on an accrual basis. Next, we've got below the line items. Well, first of all, what's the line? The line is income after taxes. So we started with sales minus cost of goods sold equals gross profit, minus operating expenses gives us operating income, plus or minus our other income or expenses gives us pre-tax income, minus income tax expense gives us income after taxes. All the stuff that's above this point are things that are likely going to persist in the future. This year's sales help us predict next year's sales. This year's wage expense predicts next year's. This year's interest predicts next year's interest. Even this year's tax expense help us predict next year's tax expense. However, there are some things that happened this year and that had impacts on our shareholder wealth and legitimately belong in net income, but have no predictive value for the firm's future performance. And these are the things that go down below the line. Discontinued operations. Daveco owned a subsidiary named Bobco, and it turned out to be a pig, lost all sorts of money, so he sold it off to someone else and maybe even took a loss on the sale. This line item will include both the operating results of that subsidiary, that really is income or loss for the period, and the gain or loss we recognized on the disposal. Bobco's performance tells us nothing about Daveco's performance next year, so we've pulled it out as a separate item. Extraordinary gains or losses. These are the things that are both unusual and infrequent. A hurricane in Florida is neither unusual nor infrequent. A hurricane in North Dakota is both. This isn't expected to happen again, so we've pulled it aside. Lastly, the cumulative effect of a change in accounting principle. If we change our accounting either voluntarily or by fiat from the FASB, we go back and pretend that we used that principle all along. And the net effect of that change on the income statement over all those years will get reported here. It's a change in the recognized wealth created by the firm for the shareholders, so it needs to be disclosed, but again won't directly help us with predictions of future earnings. You can also see that changing policies for the sake of cooking the books is remarkably transparent, so it's hardly worth doing. Each of these items will be reported net of tax. That is, the tax consequences associated with each will be included in their specific line item rather than being included in tax expense above. Why? Because that extraordinary gain isn't going to happen again. That's the point. So we won't be paying taxes on it again either. So for instance, let's say that we had an extraordinary gain of, say, $5 million, and we pay a 40% tax rate. Our income statement would actually say extraordinary gain net of $3 million. And then we'd provide more detail in the footnotes as to what this gain was all about. So now down on the bottom of the income statement, we're going to provide earnings per share figures. We of course know from last class that each share of common stock receives an equal claim on net income. And here's where we show that calculation. We provide this because no one owns Dave Corp. Shareholders own varying numbers of shares of Dave Corp. So when looking at the net income figure on the bottom of the income statement, it's hard for the shareholders to really understand what it means to their personal wealth. Earnings per share gives us that context. So we stick it down on the bottom of the income statement after net income. If a firm has $1 million of income and 100,000 shares outstanding, the bottom of the income statement would look like this. There'd be blah, 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 ending with net income of $1 million, and then we'd show earnings per share of $10. If we have any of those below the line items we talked about on the last slide, we'll pull out the per share effect of those separately. So let's say our $1 million of income included a $200,000 extraordinary loss, net of tax. We'd see that down in the per share section as well. Again, this is for predictability's sake. Looking at this income, I would expect that if nothing changed, we'd actually be expecting to earn $12 per share next year, not the $10 that we're reporting as net income. Our basic calculation of earnings per share is net income accruing to common shareholders divided by the weighted average shares outstanding during the year. We specify that it's the income to common shareholders because if we've got preferred shareholders, they're going to get their claim on income in the form of their annual dividend, and the common shareholders will split up the rest. And we use weighted average shares, not the January 1st or December 31st number of shares, because earnings happens over time, not just on January 1st or December 31st. We also report something called diluted earnings per share. And this diluted thing comes about because of those convertible securities we talked about in prior chapters. We had convertible bonds, convertible preferred stock, and while those aren't common stock, they might be. So what if they were actually converted? What would that do to our earnings per share? Diluted earnings is our worst case scenario. If everyone with a reason to convert actually converted, then what would earnings be? What is my cut as a common shareholder if that happens? So this is purely a what-if scenario. They weren't converted because if they were, they'd already be in our share count. But they might be. So what were they? What have we got? We've got warrants or options. Warrant! And these give the holder the right to buy a share of stock at a specified price. And if the market price is higher than the warrant price, warrant! These folks are going to be tempted to convert and cash out. So there are potential shares there. We've got convertible bonds. The bondholders have the right to convert their bonds into shares of common stock at their discretion. So that's another pool of potential shares out there. Interestingly, the calculation assumes that if they convert their shares, we don't have to pay their interest during the year. So convertible bonds affect our calculation in both the numerator, net income, and on the denominator, shares outstanding. Lastly, we've got our convertible preferred stock. Same deal as the convertible bonds, both in terms of having the increased shares, but also in saving those dividends will increase our earnings available to common shareholders. One last note about diluted earnings per share. We will only include one of these securities in our calculations if they actually make our earnings per share go down. In the case of a net loss per share, or if by some crazy twist of math, including a convertible security would actually increase earnings per share, we deem that security anti-dilutive and exclude it from our calculations. Within the course folder is a speech by the former chair of the SEC, Arthur Levitt, called The Numbers Game. And in it, he argues that firms have focused more and more on meeting their Wall Street earnings expectations to the point where earnings management has become commonplace. Every public firm has one or more financial analysts working for the brokerage houses who follow that particular firm and provide estimates of what they think earnings per share are going to be in the coming period. When all of those analysts' estimates are pooled and averaged, we consider that to be the Wall Street consensus. When you hear of a firm that reported earnings and they beat, met, or failed to meet Wall Street expectations, what they're talking about is this average. And firms that miss their analyst forecast earnings get punished by the market, losing significant amounts of their share value in a single day, even if they only missed the earnings target by a single penny per share. On the bottom of the earnings per share page, in your notes, is some data that I myself analyzed and shows a very interesting phenomenon. The chart shows the number of firms that fall into each penny's worth of analyst forecast error. That is, the zero bin, right here, is full of firms for which the analysts were dead on. The +1 bin, these would be they beat the analyst forecasts by 1 cent, and so on. And the -0.1 bin is full of firms that missed analyst expectations by a penny. Please ignore these two bins on either extreme because that's just an artifact of the data and includes every single observation that went above or below a dime difference per share. Now, here's the interesting thing. If we take as given that analysts are compensated on their ability to accurately predict earnings of the firms they follow, we should expect to see the average forecast error being 0. And to the extent that an analyst is wrong, it shouldn't be biased one way or the other. That is, they should be just as likely to be too high as too low. So if we put those two together, it seems that this forecast error should have a normal distribution with a mean of 0. But if we overlap a normal distribution, we see something funky. First of all, it's a horrible normal distribution, but humor me, I did it freehand. More importantly, we see that it seems to be as if some firms that should have been in this bin right here have gone missing. And it seems as if there are firms in this bin right here who don't belong there. Visually, it appears that some firms who are otherwise going to miss their earnings manage to do something at the last minute and pull themselves into the meet or beat groups. And this has been subjected to much more rigorous statistical tests than my coloring stuff in and saying, looks funky to me. Remember all that stuff we did at the beginning of this class? Earnings management is easier than you think. So, be aware of this stuff. I can't stress it too much. Understand where the gray areas are, and understand that there are strong motivations to use those gray areas for manipulative purposes. So now let's jump to the financial statements analysis component of this chapter. We will introduce some tools that can be helpful in making judgments between two firms, or about whether a firm is headed in the right direction. Before we get into that, it's worth looking at who uses financial statements, since many have different information needs and goals. When we think about financial accounting and financial statements, we immediately think of terms of the equity investor and thinking about whether or not they buy stock. Financial statement users are much more diverse than that. So we've got suppliers who care about my financial health. Why is that? Because they have to make the decision as to whether or not to extend credit to us. Their focus is going to be on our ability to make good on payments over the next 30, 60, or 90 days, and that's probably the bulk of what they care about. If our demand for their product will require them to expand their productive capacity, perhaps they'll be looking at our overall financial health to be sure that we don't go bankrupt just as they've spent gobs of money building up infrastructure to supply our needs. Employees are going to look at the financial statements from a couple directions. They too are going to care about short-term liquidity to make sure that they get paid, and they'll care about financial health for the sake of job security. But unions will use financial statements as part of their collective bargaining negotiations. If we're reporting all sorts of crazy profits, they're going to demand a bigger piece of the pie, either through wage increases or expanded benefits. Bankers are also making credit decisions, but they'll be taking a longer view than our suppliers, in that their principal will be coming due in years in the future. So they're going to care less about short-term liquidity and more about our long-term prospects. They're also going to be looking at how much long-term debt we already have on our books and how much more they think we can handle before things start to go south. Our customers want to make sure that we'll be around for them to buy from, particularly if they want to enter into a long-term strategic purchase agreement with someone. They're not going to want to get into bed with a company that might not be around in another year or two, leaving them without product to sell to their own customers. And if we're offering a product with a warranty, we're not going to be able to service those warranties if we're out of business. The people who bought Ginsu knives found that out. Regulators look at this stuff. If we're a utility and we want a rate hike, we have to justify it to the Public Utilities Commission here in Maine. And some of what they're going to look at is how profitable we've been lately. And we know that in the post-financial meltdown world, there will be government entities out the wazoo looking at everything the banking industry is doing, including their financials. And of course, investors are looking at the ability to generate future profits, which will turn into dividends and capital appreciation. Now, where do we get the information we need to perform our analysis? Primary source information is always a good place to start. All public companies file quarterly and annual reports with the SEC, and you can access those reports for free via the EDGAR database on the SEC website. In addition to the tabular financial data, make sure you look at those footnotes and also look at the management discussion. SEC rules require firms' managers to provide in the annual report a recap of what's happened this past year, how things look for the future, and to explain any major changes in financial statement figures from the prior year. This narrative will almost certainly have a positive spin on it, but it's still a good read. There are also sources of pre-digested information in case you're too lazy or you want a second opinion. Those analysts we were talking about before typically estimate not only earnings, but expected growth rates, and will sometimes write complete reports that are available for free. ValueLine is a subscription-based service that provides concise company analysis, including summary measures for expected future performance. My dad subscribed to it for years, and was of the opinion that it was a very good source of information. That was 20 years ago, though, so it's possible it's begun to suck since then. Other subscription services are Standard & Poor's, Moody's, and Dun & Bradstreet, which all provide similar types of information. Where should you not look for information? Your email inbox for a start. The people who are emailing you about stock picks are looking for nothing more than to get people to pump up the stock so they can unload their own shares at a higher price. Any sort of unmoderated forum, like Yahoo discussion groups, is the informational equivalent of Mos Eisley, a wretched hive of scum and villainy. Don't believe anything you read there, especially by anyone claiming to work for the company and has an inside scoop. Of course, if you take financial advice from your brother-in-law, you deserve what you get. On a more serious note, don't accept hot tips. The last hot tip I accepted was from the wife of a Sun Microsystems engineer back around 1998 or so. It was trading at 115 and she was convinced it would be 150 by the end of the year. So I bought some shares and promptly watched it drop to about 20. Ouch. Ware ye the hot tip. So, how can we analyze this data once we've gotten a hold of it? There are a number of alternatives depending on what we're looking for and what data we've got. The first is cross-sectional data, which is firm 1 versus firm 2 for the same period of time, or firm 1 versus an industry average. What this lets us do is filter out industry-wide and economy-wide events that make it difficult for us to see how well the firm is being run. For instance, take the airline industry after 9/11. If you were to look at Southwest Airlines, you'd say, holy crap, they sure sucked this year. And while in absolute terms that's indeed true, if you compared Southwest to virtually any other domestic airline for that same period, they'd look like the best thing since sliced bread. So using cross-sectional analysis can help us make better decisions by filtering out non-firm specific effects. The second big way to look at this information is in time series. Here we aren't comparing two firms, we're comparing one firm this year versus itself last year. This controls for firm-specific effects and can be handy when there's no other company quite like the one we're looking at. Take Walmart, for example. Whom do we compare them to? Target, maybe? I guess, but Walmart has about 6 times as much in sales as Target does. I don't know if we can really draw any comparisons between the two at the firm level. So instead, we look for trends in the data, trying to see if things are moving in the right direction or in the wrong direction. So here's some trend analysis to look at. Here's that time series data for a firm over 2 years. How have things changed from last year to this year? Do the relationships make sense? Well, our sales increased by 50%. Given that, it makes sense that our cost of goods sold would also have increased by a roughly similar amount. Good. We didn't have to sacrifice margin for the sake of those extra sales. But wait, what's this down here? Our other expenses have doubled. Maybe we could have done better with our cost control? Or maybe we expanded retail capacity to allow for growth over multiple years and we're just getting hit with extra depreciation. It could go either way, but this at least lets us know that we should look deeper to find out the reason. Or what if it looked like this? Perhaps this means that we're doing a great job of cost cutting. Or perhaps it means that we aren't increasing our R&D expenditures as we grow. And we're going to find ourselves without drugs to sell to continue that growth in the not too distant future. It's important to understand that we can't stop with this basic sort of analysis. Changes in relationships are just that, changes. They aren't good or bad unless we understand why those relationships changed, and that takes quite a bit more work. Or let's say we're going to do some cross-sectional analysis. How do we compare Target, which has $65 billion of sales, with Walmart, which has more than $300 billion of sales? Well, let's scale everything by sales or by net income and express it in percentages. Now, it doesn't matter what the raw dollar value was for either firm, since we can now see the relationships in the financial statements more clearly. And that's what I've done here. So, Firm 2 has 50% more sales than Firm 1, but by removing the dollar magnitude, we can put them on equal footing. All these numbers will be based upon 100% of their own sales. And looking at these two, what do we see? Costs of goods sold are consistent across these two firms, but Firm 2 is getting hit with other expenses down here in a way that Firm 1 is not. Is Firm 1 better at cost control, or is Firm 2 making more investments in R&D and advertising? Again, we have to look further to see what's causing that difference. So then we turn to ratio analysis, much of which we've already done as we've gone through the semester. Ratios can generally be broken down into a couple of categories, which I have listed in your notes packet. So we've got our liquidity and our solvency ratios, which focus on our ability to pay bills as they come due. There's our current ratio, our quick ratio, and a new one, our working capital, which is current assets minus our current liabilities. We've then got our leverage ratios. That's got to do with our debt. Debt is a two-edged sword. Debt allows us to earn a higher rate of return on a smaller equity investment, which is certainly good. If we can borrow at 10% and earn at 11%, how much should we borrow? As much as the banks will loan us. But debt also comes with the possibility of default, both technical due to covenant violations and real default because we find ourselves cash poor at a payment date. We have our activity ratios, which help us analyze operational efficiency. Things like our inventory turnover rates. Are we getting our inventory moved quickly enough to avoid spoilage and obsolescence? Or our receivables turnover rates. When we sell on credit, are we collecting on a timely basis? Those receivables are interest-free loans we're giving our customers, so we want those to be relatively short. Generally speaking, these help us determine how well management is doing at the helm. There are a number of profitability ratios that we haven't yet discussed. The first two are getting at the same idea but from two directions. Our profit margin percentage, which is net income divided by sales, tells us how much net profit we make on each dollar's worth of sales. This can be extremely helpful when we're trying to predict future profitability, because as firm sales grow, so too will all of its other expenses. If our company grows by 10%, what'll that do to net income? Our gross profit percentage takes that up a few levels on the income statement and looks only at what our markup is. This is a good measure to look at in tandem with our activity ratios, because if we're operating on a tight margin, we need to be able to turn over inventory relatively quickly and turn those sales into cash. If either of those falter, we could find ourselves in a cash squeeze when our own bills come due. Our third is return on assets, which looks very similar to a ratio we talked about last class, return on equity. Recall that return on equity looks at value created by management for the shareholders specifically. Return on assets takes a more holistic approach and says, management has been entrusted with a bunch of assets from whatever source, and their job is to manage those assets in a way that creates value. How have they done? While none of these ratios should be looked at in a vacuum, this ratio in particular needs to be viewed in the context of the firm's industry. For instance, banks make their profits by borrowing enormous amounts of money from you and me as deposits, and then lending them out. The margin they make on the difference between interest expense and interest revenue is not that great, but they make up for it with volume. A bank's return on assets might be 1 or 2%. A manufacturing firm or a retailing firm, on the other hand, will likely earn 6 or 7% return on their assets, so it's all about context. Our last two ratios are actually ones that I really hate, but are among the most used measures of armchair financial analysis, and these are our market strength ratios. Our first measure is the PE ratio, which is the price per share divided by the earnings per share, where earnings is typically for the most recent 4 quarters. This is most often used as a measure of how expensive or cheap a stock is, since it relates the price you pay today to the earnings per share generated. So what people will do is they'll take a firm with $1 of earnings and a price of 10 and say this firm is less costly than a firm with $1 of earnings and a price of 20, with the suggestion being that you should buy the $10 stock. This claim, however, requires quite a bit of hubris on our part, because it suggests that while we have the ability to recognize that 10 is smaller than 20, nobody else in the world is able to, resulting in a fundamental mispricing of that stock. Now you need to be very careful with this one, and here's why. How often does stock price get updated? On a minute-by-minute basis. If you were to look at intraday trading charts for most stocks, you would see the prices bopping around quite a bit. But how often does earnings get updated? Once every 3 months, right? We get our quarterly reports, but that's it. So the denominator in the PE calculation, earnings, lags the numerator by quite a bit. So now let's say that Dave Corp is that 10 PE firm with a price of 10 and earnings per share of 1. What happens if Dave Corp signs a contract with China to be the sole producer and distributor of stuff to 1 billion Chinese people? What do you think that does to Dave Corp's stock price? Considering just how much stuff a billion Chinese people can buy, I would expect that Dave's Corp's stock price would go through the roof. Now it isn't trading at $10 per share, but at 100, or 1,000, or 10,000, or since it's Dave Corp, 10 billion gazillion, or something like that. And yet, when will this piece of information be included here in earnings per share? Not for a while. And best case, the full effect won't be recognized in earnings for a year, with it more likely taking much longer as potential consumers become actual consumers as the Chinese economy expands. So if you were looking at Dave Corp's PE after this announcement, you might conclude that it's wildly overpriced compared to other stocks, completely missing the fact that it's earnings per share that's wrong, the denominator, not price. And that's not so good. So be careful. The other measure, the market-to-book ratio, is in my opinion even worse. It's like the price-earnings ratio, but instead we're looking at how much we're paying for the firm's assets rather than how much we're paying for the firm's earnings. But what do we know about book value? What is the balance sheet good for? Assessing short-term liquidity, sure, but beyond that, not a whole lot. Where do we see internally generated patents on the balance sheet? We don't. Where do we see employee value? We don't. Where do we see growth potential? We don't. What we see is a bunch of historical cost assets that have been depreciated in some arbitrary manner. Market to book is based on price, which does include all of that stuff, and book value, which doesn't. I find it hard to take the market to book ratio seriously. The FASB has been moving towards a fair value balance sheet over the last several years, and if that trend continues, then the market to book ratio will become slightly more useful, but it'll still suffer the same flaws as price to earnings. Be equally careful. Okay, last slide. Earnings quality. We've seen throughout the last 5 or so chapters that there is tremendous discretion in the financial reporting process. Not only do we have a choice in accounting method for a particular transaction, but we are also required to make estimates at almost every step in the road. And this discretion is an important part of financial accounting. If we were to pass a rule that said, all firms must record 5% of credit sales as bad debt expense, that number would become meaningless. For some firms it would be too high, for some firms it would be too low. So we have given managers the power to make these estimates so as to better communicate financial results to the financial statement user. As we saw earlier this class, there is a lot of pressure on firms to make sure they achieve earnings of a particular amount. Given that pressure, we have to expect at least a subset of firms will seek to use their discretion for the sake of manipulation rather than for information. This is what we mean when we talk about earnings quality. To what extent is reported earnings today an indicator of reported earnings in the future? And to what extent does reported earnings reflect some sort of underlying economic reality? Accrual accounting is like the Force. It is everywhere, it binds us together, and some wield it for the dark side. So how do we determine earnings quality? Well, look beyond the tabular results. Look at those footnotes, particularly footnote 1, which is virtually always a summary of our accounting policies. If a firm tends to use policies that are more aggressive, like FIFO or full cost oil and gas drilling, which lets us capitalize costs in a way we can't do with R&D, take note of that. If a firm uses policies that are less so, such as LIFO, or expensing drilling costs as they happen, take note of that. Straight line versus accelerated depreciation methods. Remember that bad debt expense footnote that we saw from Citi? Is that bad debt expense in line with other firms in the industry? Read those footnotes. Look for those one-time charges. Reported earnings per share includes discontinued operations and extraordinary gains and losses. It includes recognition of restructuring charges and then subsequent reversals back into net income. GE was the master of this, consistently reporting growth by cherry-picking assets to dispose of and other one-time events that increased or decreased earnings. Look for those R&D expenditures. We have to expense them, but we know that on average they're value added, particularly for the larger firms. That's where our sales in 10 years will be coming from. Make sure that the firm is spending appropriately and that you are recognizing them not as expenses, but as likely assets. And look at spending over time. Did they achieve an earnings target at the cost of reduced R&D expenditures this year? If so, that really ain't so good. Lastly, look for those contingencies. What do you think BP's contingencies section looked like after the Gulf oil spill? And what about Toyota's contingencies section looked like after that faulty acceleration thing on all those cars that they had to recall? And don't forget that the difference between accrual and disclosure is the difference between highly probable and reasonably probable. Make sure that you agree with those estimates that they put out there. The next class will be the cash flow statement, and that'll wrap up our section on financial accounting.